Hello and welcome to my channel, where I share tips and tricks on how to invest your money wisely and make it grow. Are you ready to make your money work for you? Today, we're diving into the fascinating world of investing in UK shares. In today's video, I'm going to show you how to intelligently invest $1,000 in UK shares. Before we delve into the specifics, let's first understand the potential of UK shares. The UK stock market offers a diverse range of investment opportunities across various industries, such as technology, finance, healthcare, and more. By investing in UK shares, you can tap into the nation's economic growth and potentially reap substantial rewards. You might think that $1,000 is not enough to make a significant difference in your wealth, but you'd be wrong. If you invested wisely, you can turn it into much more over time. But how do you do that? Well, there are two main things you need to consider: what to buy and when to buy. The first thing you need to do is to decide what kind of shares you want to buy. There are thousands of companies listed on the UK stock market, but not all of them are worth your money. You want to look for shares that have strong fundamentals, good growth prospects, and attractive valuations. You also want to diversify your portfolio across different sectors, industries, and regions to reduce your risk and increase your chances of success. One way to find good shares to buy is to follow the recommendations of experts and analysts who do extensive research and analysis on various companies and sectors. You can find their share tips on websites like MoneyWeek, Fool UK, and Investors Chronicle. These websites provide regular updates on the best shares to buy, sell, or hold, based on various criteria and strategies. Another way to find good shares to buy is to use a stock screener, which is a tool that allows you to filter and sort shares based on various parameters, such as price, earnings, dividends, growth, value, and more. You can use a stock screener to find shares that match your investment goals and preferences, and then do further research on them before making a decision. You can find free stock screeners on websites like TradingView, London Stock Exchange, and BBC News. The second thing you need to do is to decide when to buy the shares you have chosen. Timing is important, because you want to buy low and sell high, to maximize your profits. However, timing the market is not easy, and it can be very risky. You don't want to buy a share when it's at its peak, or sell it when it's at its bottom. You also don't want to miss out on a good opportunity, or hold on to a bad one. One way to avoid timing the market is to use a strategy called dollar cost averaging, which means investing a fixed amount of money at regular intervals, regardless of the price fluctuations. This way, you can reduce the impact of volatility, and average out your purchase price over time. For example, if you have $1,000 to invest, you can invest $100 every month for 10 months, instead of investing $1,000 at once. This way, you can buy more shares when the price is low, and less when the price is high, and end up with a lower average cost per share. Another way to avoid timing the market is to use a strategy called value investing, which means buying shares that are undervalued by the market, and holding them for the long term, until they reach their true value. This way, you can benefit from the power of compounding, and earn higher returns over time. For example, if you buy a share that is worth $10, but the market price is only $5, you can wait until the market price rises to $10 or more, and then sell it for a profit. This way, you can ignore the short-term fluctuations, and focus on the long-term potential. You might wonder if it is worth to invest in UK stock market or best to invest in the US stock market. There is no definitive answer to whether it is worth to invest in the UK stock market or the US stock market, as both have their advantages and disadvantages. However, some factors that may influence your decision are: the performance of the two markets. The US stock market has outperformed the UK stock market in recent years, especially in 2020, when the S&P 500 gained 16.3% and the FTSE 100 lost 10%. However, Past performance is not a guarantee of future results, and the UK market may catch up in 2024 and beyond. The valuation of the two markets. The US stock market is generally considered to be more expensive than the UK stock market, based on metrics such as the price-to-earnings (PE) ratio, the dividend yield, and the cyclically adjusted PE (CAPE) ratio. This means that the US market may have less room for further growth, and may be more vulnerable to a correction or a crash. The UK market, on the other hand, may offer more value and potential upside. The currency risk of the two markets. If you invest in the US stock market, you will be exposed to the exchange rate fluctuations between the US dollar and the British pound. This can add to your returns or reduce them, depending on the direction of the currency movements. If you invest in the UK stock market, you will not have this currency risk, but you may miss out on the benefits of diversifying your portfolio across different currencies. Ultimately, the best choice for you may depend on your personal preferences, risk tolerance, time horizon, and investment goals. You may also consider investing in both markets, or in a global index fund that covers both markets, to achieve a balanced exposure. As for the best UK stocks to invest in 2024, there are many options to choose from, depending on your criteria and strategy. However, here are some examples of UK stocks that may be worth considering, based on their growth prospects, financial performance, competitive advantages, and valuation. Cerillion, LSE, CER. This is a software company that provides billing, charging, and customer relationship management solutions for the telecoms industry. It has a strong track record of revenue and profit growth, and has recently signed a major contract with a Tier 1 telecoms provider in Europe. It also has a high return on capital, recurring revenues, and a reasonable PE ratio of 29. Digital Group, LSE, DOTD. This is another software company that offers solutions for digital marketing and e-commerce. It has a large and loyal customer base, and benefits from the increasing demand for online marketing and sales. It has also expanded its geographic reach and product range, and has delivered consistent growth in revenue, earnings, and cash flow. It has a PE ratio of 36, which may seem high, but reflects its growth potential. Unilever, LSE, ULVR. This is a consumer goods giant that owns many well-known brands, such as Dove, Ben & Jerry's, and Lipton. It has a diversified portfolio of products, markets, and channels, and has a strong focus on sustainability and social responsibility. It also pays a reliable and attractive dividend, with a yield of 3.6%. It has a PE ratio of 21, which is lower than its historical average and its peers. ASOS, LSE, ASC. This is an online fashion retailer that sells over 850 brands of clothing, shoes, accessories, and beauty products. It has a loyal and growing customer base, especially among young and trendy shoppers. It has also benefited from the shift to online shopping during the pandemic, and has acquired some of the assets of the collapsed Arcadia Group, such as Topshop and Miss Selfridge. It has a PE ratio of 25, which is reasonable for a growth stock. Games Workshop, LSGAW. This is a manufacturer and retailer of fantasy miniatures, games, and books. It owns the popular Warhammer franchise, which has a loyal and passionate fan base. It has also expanded its revenue streams through licensing deals, digital products, and media partnerships. It has delivered impressive growth in revenue, earnings, and dividends, and has a PE ratio of 32, which reflects its strong brand and niche market. Ocado Group, LSE, OCDO. This is an online grocery retailer and technology provider. It operates its own online supermarket, as well as providing solutions for other retailers, such as Marks & Spencer, Kroger, and Kohl's. It has a leading position in the online grocery market, which is expected to grow rapidly in the future. It has also invested in innovation, such as robotics, artificial intelligence, and vertical farming. It has a high PE ratio of 163, which reflects its growth potential and future profitability. Remember, investing is a journey that requires patience, research, and continuous learning. Diversification is crucial when investing your $1,000. Regularly monitoring and managing your investments is crucial for long-term success. So, start today and let your money work for you. If you found this video helpful, don't forget to like, share, and subscribe for more valuable investing tips. Until next time, happy investing!